Hello, my name is Angela Escobar. I am currently a student in the Master's of Business Administration program at Eastern New Mexico University. I am employed by a health insurance provider and would like to disclose that as a potential conflict of interest before beginning today's presentation on ethical issues in insurance fraud. Insurance is a big industry in the United States. According to the Federal Bureau of Investigation, or FBI, there are more than 7,000 insurance companies in operation, which collect over $1 trillion in premiums each year. Insurance policies are available to offset the costs of major catastrophes like floods and fires, to protect your life savings or your company's investments and interest rates, and to pay for medical and dental expenses. There's also mortgage insurance, shipping insurance, vehicle insurance, travel insurance, and pet insurance. The list goes on and on. As of July 7, 2017, Wikipedia contained 93 separate pages describing types of insurance. The purpose of insurance is to protect an individual or business against risks associated with a particular item, activity, or event. For example, if a business holds insurance which protects its assets from fire, and the business experiences a fire with loss of those assets, the insurance policy will pay out per the terms of the insurance contract so that the firm can replace the damaged assets. The basic premise of insurance is that individuals and businesses are willing to pay premiums in order to be part of a larger risk pool of insured policyholders. The insurance company carefully calculates the statistical risk that any one of its many policyholders will actually experience a fire in a given time period and the expected cost of such an event. Each policyholder pays into the pool in the form of premiums, and in return, the insurance company agrees to use the pooled money to pay for any claims that are submitted, minus deductions for operating and other business expenses. Insurance policies often require the claimant to pay a deductible or another form of cost sharing when making a claim against the policy as a way to reduce the insurance company's payouts, as well as to prevent fraudulent claims. So what is insurance fraud? Basically, insurance fraud is any attempt on the part of the insured or the insurer to manipulate the insurance contract or claim process to gain some personal or business advantage. It can take many forms, as we will see during this presentation. The size of the United States insurance industry means that there are, unfortunately, ample opportunities for insurance fraud. This presentation will explore legal aspects of insurance fraud, examples of business-related insurance fraud, ethical aspects of selected types of insurance fraud, and steps that organizations can take to decrease the risks of becoming involved in insurance fraud. According to uslegal.com, insurance fraud is not generally a distinct criminal offense at the federal level, but often can be tried under mail and/or wire fraud statutes, such as the Violent Crime Control and Law Enforcement Act of 1994, or the Racketeer Influenced and Corrupt Organization statute in instances where the fraud has occurred across state lines or has involved transactions conducted through the U.S. Postal Service. Individual states, however, have legislation that recognizes most, if not all, types of insurance fraud as a criminal offense. An exception to this is the healthcare insurance fraud, which is subject to the Federal Health Insurance Portability and Accountability Act of 1996. Which defines knowingly and willingly making fraudulent claims against a health insurance contract and embezzlement of health insurance premiums, federal crimes. Next, let's look at some examples of insurance fraud. The first is premium diversion. According to the FBI, this form of insurance fraud is an infraction against the insured party. In premium diversion, the insurance company fails to use premiums to actually pay claims. Instead, the insurance agent or broker embezzles the funds for personal use, while the client remains unsuspectingly uninsured. A July 7, 2017 publication by the Associated Press provided a recent example of premium diversion in action. Wesley Michael Woodyard was sentenced in Dallas to 7 years in prison and a repayment of almost $4 million in misappropriated funds. Woodyard was charged with wire fraud and found guilty of taking money intended for annuity purchases for workers' compensation type claims for beneficiaries of ACE European insurance policies. Premium diversion is one of many types of sales-directed crimes, according to Brian K. Payne's 2016 book, White Collar Crime: The Essentials. Other types of sales-directed crimes are churning, which is an attempt on the part of the agent to get existing policyholders to modify or upgrade their policies in order to generate agent sales commissions, often leaving the company with insufficient funds to actually pay any claims. Stacking, in which the agent knowingly sells more products than the client needs. And sliding, such as sliding extra products into a client's portfolio that they did not request or intend to purchase. Of course, it's also possible for an insured party to attempt to defraud the insurance company. This can occur through what are known as hard fraud and soft fraud. Hard fraud consists of blatant attempts to gain undeserved benefits, such as staging a fire that results in a loss of business assets in an attempt to receive compensation for the damages. Soft fraud, on the other hand, does not involve completely falsified claims, but rather exaggerations of otherwise legitimate claims, or supplying the insurance company with false information in order to receive a discounted premium rate. In the fire example, a business may genuinely experience a fire with a loss of assets, but when itemizing affected assets on the claim form, the claimant may list assets that were not actually lost, or may overstate the value of lost assets. Soft fraud is taking advantage of the opportunity to submit an insurance claim in order to gain undeserved benefit from the situation. The nonprofit group, the Coalition Against Insurance Fraud, estimates that hard and soft insurance fraud directly costs insurers at least $80 billion annually, with indirect costs, such as lost productivity and investigation-related expenses, bringing the costs considerably higher yet. The remainder of this presentation will discuss ethical issues specifically related to business-related soft insurance fraud, opportunistic fraud committed against an insurance company, including reasons given to justify fraud, ethical principles related to insurance fraud, as well as the impact of fraud on society. There are a number of justifications that research has found may be implicated in a decision to submit fraudulent insurance claims. One of these is that padding a claim is necessary in order to recover premium payments or deductibles. Furthermore, the higher the deductible payment, the more tolerant individuals tend to be of claim padding, with a correlation between deductible amount and perceptions of the fairness of submitting padded claims. Another study found that this effect was exaggerated when there were no witnesses to the incident, presumably because the claimant was less concerned about being caught padding claims. But while insurance consumers may be tempted to take advantage of the opportunity to receive a claim payout that reimburses them for premium expenses or for which they feel justified due to their perception of the unfairness of a high deductible, ultimately the decision to submit a fraudulent claim is an ethical one. As pointed out by Brinkman in his 2005 article, the choice is one between self-interest and interests of others, such as the insurance company and other insured clients who have contributed to the pool of insurance funds. This differentiation between self-interest and the interests of others aligns with stages 2 and 3 of Lawrence Kohlberg's model of cognitive moral development. Claimants who have not developed past stage 2 are inclined to look out for their own benefit and profit and may not consider how their actions may affect others, or possibly even how their current actions will affect themselves in the future. A claimant in stage 3 or higher has become aware of how his or her actions affect other individuals and organizations, is likely to recognize the ethical aspects of the situation, and may be more likely to choose to submit an honest and accurate insurance claim. Another important aspect of moral and ethical decision-making is the underlying individual moral philosophy of the claimant. A manager who has adopted a utilitarian moral philosophy guided by rules will be concerned with achieving the greatest good for the greatest number of people and following overarching principles that guide moral and ethical behavior. This manager would determine that submitting a fraudulent claim is wrong because acting deceitfully is wrong. Similarly, a manager who has a deontological approach to ethical decisions will also determine to not submit a fraudulent claim, but for different reasons. This manager would act in alignment with Immanuel Kant's categorical imperative. He or she would be unwilling to pursue actions that would be unacceptable behavior if everyone did them, or if they were visible to all of society. This is well aligned with the research findings mentioned previously, in which claimants were less likely to submit a fraudulent claim if there were witnesses who could potentially call them out on their deception. On the other hand, a manager who has adopted a relativist perspective will see moral and ethical decisions as situationally variable. This manager may feel that because the company has a high deductible, the total amount claimed should be high enough to offset that deductible. The manager may also believe that padding insurance claims is a common occurrence, and the firm may not get their fair share of insurance money if he or she does not exaggerate the losses. This everyone does it mindset has been documented in the literature as well. Ultimately, the impact of fraudulent claims on individuals, businesses, and society is huge. As previously mentioned, according to the Coalition Against Insurance Fraud results in an estimated $80 billion each year in direct costs to insurance companies, and there are numerous other indirect costs. In the case of hard fraud, such as arson, there are costs related to damage to adjacent property and injury or death of the arsonist, bystanders, or emergency response personnel. But there is collateral damage in cases of soft fraud, too. For example, padding claims by overvaluing damaged assets will eventually lead to higher premium payments for all insured parties as the insurance company passes along these costs. Businesses that must pay higher insurance premiums will have fewer resources to contribute to employee pay and benefit plans, and reduced capital to reinvest in the business or to distribute to shareholders. They may decide to raise prices and pass along the higher costs to their own customers as a means of staying profitable. Businesses must choose to make insurance claim decisions with integrity and honesty to promote corporate social responsibility. One way a firm can promote ethical decisions is by developing an ethics program that specifically identifies insurance fraud as a situation which should never occur. Although employees and managers may see a padded claim as beneficial to the company's balance sheet, and thus see it as a decision in the best interests of the company, a code of ethics that describes the correct process for submitting insurance claims and education regarding what constitutes insurance fraud may be helpful. There should be an effective and confidential means of reporting suspected fraud, clearly communicated consequences for participating in fraud, and consistent messaging from top management that fraud will not be tolerated, even if the intent is to obtain financial benefit for the company. Richard Cascarino's 2013 book, Corporate Fraud and Internal Control, outlines the importance of establishing a strong ethical organizational culture as primary means of preventing fraudulent behavior, including establishing internal controls such as segregation of duties and limitations of authority to prevent an opportunity for fraud to easily occur. In conclusion, soft insurance fraud, as well as other types of insurance fraud, places a great burden on individuals, businesses, and society. The insurance model can only be successful if insurance companies can predict future claims with reasonable accuracy, and each fraudulent claim contributes to systemic instability. Businesses have the responsibilities of meeting the objectives of many stakeholders and doing so in an ethical manner. Implementation of insurance fraud-related ethics training and monitoring is highly encouraged as part of a comprehensive ethics program. Thank you so much for joining me for this presentation. I wish you all the best as you identify opportunities for insurance fraud education and prevention in your own organizations.